welcome everyone. My name is Steven Boyce and I'm really pleased and excited that you can join us for our investment webinar session. So today's webinar is going to cover a range of different topics. We're going to give you an update on financial markets as well as answer questions that have been asked by our clients to us over the past couple of months. You're going to get some really great insight today into this strange disconnect that's happening in the world in terms of we've seen a really strong rebound in investment markets, but all the news we're hearing is painting a pretty grim picture around the state of the economy. We're also going to run through the stimulus packages and how they work, but most importantly, and we want you to use the chat box and ask as many questions as you possibly can. Hopefully we're going to get a really good opportunity for our panelists to be able to answer a lot of those lives. So get involved and ask questions. That's what it's all about. So I want to take some time to introduce the panel. So firstly, we've got Dave Andrew. Dave's our founder and the CEO of Capital Partners and also a member of our investment committee. He's the author of Wealth with Purpose, a common sense guide to wealth, investing and an inspiring life. Secondly, we've got Michael Matthews. Michael heads up our investment committee. He's a chartered accountant, senior fellow of FINSIA and the CFEX fiduciary. He's got broad knowledge and experience and is sought after in the areas of financial planning, portfolio construction and risk management. And finally, we've got Graham Lennon, and this is a big one, Graham. So Graham's our external independent investment committee member. Prior to joining our investment committee, Graham was Senior Vice President with Dimensional Fund Advisors. Graham was also a member of DFA's Global Investment Policy Committee, which comprised their most senior investment staff around the world. As a portfolio manager, Graham oversaw the design, implementation and refinement of investment strategies, working closely with the firm's investment and research teams, as well as with external academics. As head of international portfolio management, he was responsible for all non-US assets valued at over 150 billion across the US, across Australia, the UK and Asia. So gentlemen, thank you very much for joining us today. I'm looking forward to the chat. So Dave, we're going to start with you. So what have you seen to be the biggest challenge for clients and also for capital partners during this COVID crisis?
Yeah, thanks, Steve. I think the biggest issue for all of us has been dealing with the uncertainty. Very early on in the piece, I wrote an article that was entitled, "This is not 2008." And I spent the next month or so worrying that I'd been too optimistic. But as the COVID-19 crisis has unfolded, I still maintain the view that this is not 2008, in that this is a financial system crisis, while the GFC was a financial system crisis, where COVID-19 is clearly a health crisis with severe economic and perhaps pretty severe political implications for some countries as well. As a business, I think it's fair to say our primary concern has been the safety of our people and of our clients. So we have been very diligent in following the health pronouncements and the like. But really, the main work for us and really our highest priority after health and safety has been being there for our clients when they need us most. Many people had deep personal concerns about their health and their safety, which is really unique about this crisis. But also there have naturally been concerns about financial security. When markets fell very, very quickly by circa 30%, there was, a lot of phone calls, and thankfully most of them were outgoing from us to clients, just chatting with people about the state of the world. And I'm always reminded when these events occur that as humans, we're really poorly wired for uncertainty. Deep in our brains, there's a little part of the brain called the amygdala, which is our long-term genetic inheritance of the fight or take flight response. So when we feel threatened as humans, we feel deeply concerned, and we're either going to run away or we're going to be, fighting the situation. And during that, when people are feeling really anxious, our job as advisors has been to keep our clients on track. And that's not always easy to do. I always find it fascinating that when we have a market, some market turmoil, some people take it in their stride and others are genuinely fearful. And I've thought a lot about that and tried to understand why that is. And I do think that during those difficult times, having a clear plan really helps. It's that thing that anchors people back to a logical and rational set of expectations. I think during the good times, and certainly as new clients join us, it's really quite hard to communicate just how volatile markets are. And I guess, Steve, just how careful we have been to build a plan and build in uncertainty so that when these events come along, whilst you feel uncomfortable, you don't have to panic and you don't have to be too concerned about it. Very easy to rationalise that thinking during the good times, much harder to deal with it emotionally when times are stressful. But I am very pleased to say that through all of this, our clients have been extraordinarily disciplined and have remained on plan. So the outcomes, whilst people have seen this happen in their portfolio, they're also seeing the rebound. No one enjoys these moments, but they're very hard to predict and they're very hard to see in advance. So for us, the last few months has been about communicating regularly with people. And what's been lovely and different this time around, I think it's perhaps because people have had a bit more time, is that we've been getting lots of questions fed to us. And that's meant that we've been able to respond to them and share those responses with a much broader audience. And we've had really great feedback on some of that communication. But I think also it's about being consistent and being on the front foot. Where I've landed personally on this is I've reached a state that I call rational optimism, and a psychologist friend has helped me think this through. And that is, whether it's your life in general or whether it's your relationship with financial markets, there's a point of acceptance where you realise that the world isn't always going to be perfect. The world isn't always going to deliver the result that we would hope for. And in fact, sometimes it can be pretty awful. But having a plan in advance that deals with a lot of those contingencies and helps us understand what to do when we're feeling uncomfortable is a really, really good starting point. So I think that's probably my key message out of all of that, is just maintaining a sense of rational optimism, particularly now because, as we see these mass demonstrations around the world, in places like the United States, where COVID is not as well controlled as it is in Australia, it's entirely possible that we will see a second wave, and it's entirely possible that second wave will be awful. And that may well have an effect on investment markets. So having a sense of rational optimism helps us take into account all of the factors and say, look, it's not perfect at the moment, but we are going to get through this. And for Australians, I sense we're probably feeling pretty good about ourselves now. And well done to all of you out there who have done the right thing with social distancing and the like. But I don't think we're out of the woods yet. We're really just at the very beginning of seeing how this pandemic and the results of it, the impacts of it, unfold. Back to you, Steve.
Thanks, Dave. And just like in terms of, you talked a bit about 2008 and some lessons that might have been learned there. Are there any insights that you have, either running a business now relative to what happened during the GFC, or from an investment perspective? Are there any lessons that you learned which you can share with the audience around, which might have helped you this time around?
Well, very specifically, yes. We went into the GFC with money in the bank, and that is what got us through. And we've come into this crisis in a very, very strong financial position. We feel we owe it to our clients to maintain that strength, because we need to be there. They can't afford to have us falling off. They need us most. And we don't have any debt. So we've been really, whether that's good planning or good luck, you can decide. Where I think it's been fascinating in this crisis is just how diverse the outcomes have been. So a business like ours, there are whole sectors that are still doing really, really well. And there are whole sectors that have been hit really, really hard. So if you're in travel, tourism, hospitality, airlines, really there's nothing you could have done to plan for this. No amount of money in the bank would have made any difference. And I really feel for those people. We've got some client businesses that have really come under a lot of distress. And I really feel for those people because, as I say, nothing you could have done would have planned for that. For other businesses, I think people who do come out of this crisis will come out of it really thinking deeply about how they fund their businesses, how they think about growth, the balance of keeping money on balance sheet, keeping your business very, very healthy, not having too much debt. I think they're all things for another day, but I think they're things that Australian business will certainly take a very close look at in time.
Great, thanks, Dave. So, Michael, just from your perspective, it'd be really good to get an update on where financial markets are at the moment. So it's definitely been a roller coaster. There's the big fall in March and the subsequent recovery, which people are reading in the news. And it seems like it's settled down a little bit. So do you mind just sharing a little bit of where markets are at the moment and how you see things?
Thank you, Stephen, and good afternoon also. I am very pleased to be providing this update at a time when there appears to be a level of calm. And this is certainly in contrast to when we presented back in early April, notwithstanding the confronting developments with the riots in the US. So, starting with some well-needed positive news, many of the developed economies, including those recently among the world's hardest hit by this pandemic, are now beginning to reopen their economies. And this progress on the road to economic recovery should very much help offset pressure on equity markets in particular from near-term challenges stemming from geopolitical, health and societal risks. The not so good news is that growth in the US economy and Europe has been contracting over the last few months at the steepest pace since the 1930s, inevitably leading to a fairly deep recession. Regarding the outlook, there is much conversation amongst forecasters and economists about how this global recession should be short, with growth turning positive in the second half of this year. And that said, we do expect the recovery will take some time, in that it may well be until at least the end of 2021 before economic activity returns to its pre-COVID-19 level. We do expect the recovery to proceed in two stages, along the lines of what we're beginning to see in China. Firstly, a bounce back in growth as supply constraints recede, and then a longer wait for demand to strengthen. The major test, though, will be later this year when the stimulus packages such as JobKeeper are lifted, and we will see just how resilient businesses are without that level of government support. So let's now have a look at how financial markets in particular have fared during this time of heightened uncertainty. So while the main indices for global share markets are still some 9% off their pre-COVID-19 peak, and the local S&P 300 index is still 19% off its peak, we have seen encouraging signs over the past 4 to 6 weeks across all markets. In the US, the S&P 500 index, which is the measure of performance of the largest 500 US listed companies, has improved by some 18% over the quarter, with our S&P 300 index having improved by 14.3%. Gold over the same period has continued its march, with the spot price increasing by around 10%. Interest rates have remained stable, with a slight improvement in the market for corporate bonds. Our currency has also increased slightly against both the US dollar and the euro, which does bode very well for when international travel resumes. So navigating uncertainty on a daily basis is everyone's new normal. And we've all been thrust into a world where all aspects of our lives are being reevaluated and re-examined using a new lens. And it's forcing many of us to focus on the things that will keep our eye on the end game. It is true that this downturn is different, and each downturn has had its own fingerprint and differing factors driving down market performance, yet they have all recovered. It is good news in that the likely recovery from this current downturn is predicted to be relatively swift.
Great, thanks, Mike. I think this is a really good segue into the next question for yourself, Graham. So it's a question that I'm getting a lot from my clients, is just this, this seemingly seeming disconnect with the fact that the markets have gone down but also rebounded really strongly, and that disconnect between the rebound versus the pretty grim reality of what's been painted in terms of the actual economic circumstances that we're going through right now. Obviously, our talks of recessions and different things. So would you mind just sharing your thoughts around that disconnect and how you see it?
Yeah, Steve, thanks for the question. It's a very good question. And I think this has been a very good example of how financial markets work. We've got to always remember that financial markets are forward-looking, and the prices quickly reflect all new information as it arrives. So for example, let's look at how the stock markets work to try to value a company. So what happens is, like, market participants try to, they're doing this all the time, trying to estimate the future cash flows that a company will generate, and then they use these estimates to come up with a value for the company now. Now, the more uncertain the estimated future cash flows are, the less an investor will pay for the company. Now, if the company stays in business, it can generate cash flows for many, many, many years into the future. If a company is expected to generate strong cash flows for many years, a relatively short-term interruption to these cash flows may not have a major impact on the value that investors place on the company today. So what's been happening in this crisis? So this crisis was caused by governments shutting down companies' operations to protect public health. And it's hoped, as Michael spoke to, that as these restrictions are lifted, that business activity will bounce back quickly. So if we remember back into March when this crisis first hit, there was great uncertainty. It was expected that the future cash flows for companies would drop, but by how much and for how long was just totally unknown. And in addition to that, there were grave concerns that many companies may not survive the crisis at all. So this combination of lower expected future cash flows with great uncertainty led to a sharp reduction in prices. But as Michael mentioned, since then, these prices have partially recovered. And presumably, this is due to a combination of a few things. There's greater confidence in the market that companies are going to survive. There's probably an expectation that the cash flows may not be reduced by as much as people originally feared back in March. And also there's been a reduction in uncertainty to some extent. But the other things that have been happening, which have likely influenced this improvement in prices, is that the government, there's been lots of stimulus. This government stimulus aims to firstly help companies survive, and secondly to help business activity quickly increase as restrictions are lifted. In addition to that, central bank policies have meant that debt capital is both cheap and very readily available. And in many cases, governments are giving direct payments to companies, JobKeeper, etc. Also influencing this, it's probable that the increase in stock prices may have been influenced by the lack of other attractive investment options available to people out there, which encourages investors into the stock market. For example, investing in bonds, the yields are incredibly low. So to some extent, investors don't have a lot of alternatives to the stock market. But despite all this, despite the recent good performance and everybody feeling a little bit calmer, there still really is a very high level of uncertainty out there relative to more normal times. But stock market volatility, whilst not as high as in March, still remains quite high. And new information is being processed by investors every day. And this is still causing relatively large movements in stock prices. You expect a 1% or 2% every day at the moment, which is not normal. We don't know how this, in addition to this, as David related to, we don't know how this crisis is going to be resolved, either from a health or an economic perspective. Yes, but what we do know is stock prices will continue to move up and down as more is known, as new information comes through, but nobody really knows what's going to happen next.
Thanks, Graham. So you talked about the stimulus packages, and I'm just keen to unpack that a little bit more. So, it's kind of hitting the headlines around, central bank as well as government intervention, in Australia, but also around the world. Can you just step us through, like, what does that actually look like, and how do the stimulus packages how do they work?
Yes, Steve, so you're right, there's been a lot of stimulus, and so there's a lot to cover to respond to your question there, but I'll try to do what I can to get through that fairly quickly. So what's been happening around the world, as you mentioned, that central banks have been providing lots of monetary stimulus, and governments have been providing lots of fiscal stimulus. So the main aim of central bank monetary stimulus is to make money cheap and easy for companies and households to borrow, to keep borrowing, so you can borrow money. Usually, central banks' main policy lever to do this is interest rates. But with interest rates really low prior to the crisis, they've also had to use other levers to implement monetary policy. In addition to setting near zero interest rates, central banks have done a few things. They provided cheap funding to banks to allow them allow the banks to lend cheaply to their customers. And they've also gone into the markets and purchased bonds to keep longer term interest rates low, and really importantly also to ensure that these bond markets and these debt markets continue to function effectively. Now the central banks have funded this, so there's been a lot of money going into the economies. But they funded this by expanding money supply. They actually create or print this new money that they then use to buy bonds or to lend to banks. And so around the world, banks have massively expanded money supply, and they've injected billions, indeed trillions of dollars into economies. This has had the effect of expanding the balance sheet of these central banks, because in return for providing this newly created money, the central banks receive debt instruments like bonds. So that this new money that they create is not given away, they receive back an asset in return which they can sell in the future. But in addition to all this central bank activity, aiming to keep borrowing cheap and easy, governments are also providing huge amounts of money to the economy via fiscal stimulus. The aim of this fiscal stimulus is to provide liquidity to individuals and companies to keep them solvent during the crisis, and to also stimulate the economy so that it bounces back after the crisis. Governments do this by spending money in the economy, by providing money directly to individuals and companies for them to spend, and also by taking less money from individuals and companies via lower taxes. And there's all sorts of other programs designed to increase economic activity and to create jobs. Now, this fiscal stimulus is funded by governments borrowing money. They sell newly issued bonds to investors like us. They have to pay interest on these bonds, but at the moment, these interest rates are really very, very low due to the central bank activity. So, for example, the Australian government has been issuing 10-year bonds at about 1%, which is pretty cheap money. But unlike the central banks, unlike the money the central banks are pushing into the economy, the money used for the government's fiscal stimulus will ultimately need to be repaid when the term of these bonds expire.
So I mean, that leads to the next obvious question for you, Graham. Like, how is all this money going to be repaid? So what will be the plan for governments and central banks to repay all these borrowings?
Well, we should. So firstly, the central banks are not borrowing money. Right? So the point I made is that some commentators will link together this monetary stimulus and the fiscal stimulus, add them up and say this is a really big number. But it's only this fiscal stimulus that's actually creating a debt that needs to be repaid. The money supply issue is just something the central banks do, putting money in and out of the economy as times change. So we only really worry about the government, the debt associated with the fiscal stimulus. Secondly, people I think are rightly concerned about the fact that debt's increasing, but we should sit back and think about what was the alternative. What could have happened if the governments didn't intervene the way they have? Huge parts of the economy could have been completely killed, and it could have taken many years, perhaps decades, to recover. So it's something that we've had to do. A really good thing was that relative to other companies, we had reasonably low levels of government debt, which gave our governments capacity to put all in this more borrowing in. But as you said, Steve, it is borrowing, and all this fiscal stimulus has increased government debt, and that debt needs to be serviced. Even though it's cheap to service, but it still needs to be serviced, and will need to be repaid at some stage in the future. It's possible that in the future governments may need to reduce spending or increase taxes because of this debt, but we really don't know. We've got a budget coming up in October and so on, so it will be, what happens next will be really dependent on how the economy performs and a whole lot of other issues. But it's going to take many years to work through this crisis.
Thanks, Graham. So really good question that's come through on the chat. So Michael, I'm going to drag this to you. So our clients have shifted about 12 months ago. There's a shift towards a higher weighting of international equities relative to Australian shares in the growth component of the portfolio. So the question's around that in terms of how has that actually played out, and is the rationale, and what was the actual rationale behind that decision?
I kind of wish Steve had have asked me the same question you put to David about what have we learned from GFC, because the answer to that question is really the answer to the question about the change in asset allocation. The thing that you learn through experience, despite how much you read and study, is that the best way to deal with a crisis is to be prepared before the crisis. The old saying, get your ducks lined up long before you need them to be, and that's essentially what David was talking about in the business, and it's certainly something that we have been very disciplined and diligent within client portfolios and asset management generally in seeking to create wealth, not from only choosing the better investment opportunities, but also minimising the risk of losses. And the old cliche of the only free lunch is diversification plays out here, which we've been looking at how the world economically is unfolding long before the crisis, and whether we sort of politically like it or not, the world is very global in terms of economic activity. And so the rationale behind increasing the exposure to the developed markets internationally and reducing exposure to the Australian markets was predominantly about de-risking and overexposure to resources bank and tourism, which being the main industries here, and increasing the exposure to many industries that we just don't have exposure to in Australia. I would love to say that we did that planning for some major crisis, but that's not true. It has played out very favourably, only with the benefit of hindsight, in that we have seen, Steve, across every portfolio, a stronger rebound in the international share components ahead of that of the Australian component. So while it's been great with hindsight, the rationale was fundamentally diversifying and therefore reducing risks within portfolios.
So Mike, does that lend itself? I mean, obviously that means that, you know, we could be changing this again in the future, but does that lend itself to, you know, potentially, again, we might see a move at a different point in time to even increase the international weighting further? Obviously, it's a process that we're going to be, you know, the investment committee, I'm sure, would look at regularly, but I'm assuming this is quite a dynamic thing that, you know, that we're always testing and looking at over time.
I think that's the better way to look at it. It's not so much that there will be in particular a change to the mix, a change to the proportion allocated to global equities versus Australian. It's more that the whole process of wealth management is dynamic based on what research is showing, what's occurring in practice, what different economies are doing, where currencies are going, interest rates are going, and so on. So while there are some truths in investing, you know, as in it's you buy well, you know, buy low, buy well, sell high, those sorts of things. Our ongoing real-time perpetual review of markets and opportunities is about capturing both highest expected returns while minimising risks where possible. So, you know, the short answer to your question is yes, it is probable over time that we would have further changes in the geographical proportion of equities. Can't tell you when, but if you think of it more in terms of changes will be made as we see there is significant benefit in doing so.
Yeah, thanks, Mark. So another question that's come through on the chat, I'm just going to summarise this one for yourself, Dave. So it's around confidence in the way that we're actually investing, being able to deliver for our clients or for clients in the long term. So I think it would be interesting for you to just give some context of has our investment philosophy changed in the last 20 years since this business has been around? And how can you have confidence in terms of the way that we're investing is actually ultimately going to work for clients?
Yeah, okay. I just want to gather my thoughts on that one. I'll start at a high level by saying that when things are really good, people really ask very few questions, and I guess that's natural. When things are tougher and people see their portfolios have gone down for whatever reason, they ask a lot more questions. And I guess I'm raising that because we really want to encourage these questions. You know, I think it's very good discipline for us to A, receive the questions, and B, have a coherent answer to them. To one part of your question, our investment management approach has changed enormously over 20 years in that we've always had the same intent, in that we've never tried to be top of the pops. We've never tried to win headlines as being the best performing anything. We're far more concerned about making sure our clients can sleep at night and that they don't lose money. So in the early years, yes, we have tried to pick direct stocks and we've tried to build portfolios of direct stock market investments. We've tried to pick the best fund managers. And there's stories around that that I won't repeat now in the interests of time, where you know, a decision would be made and only a matter of weeks and months later we'd have to reverse that decision because things have shifted so quickly. So we have searched the world for a process that is systematic. I think we call it evidence-based, we call it asset class, but it's systematic. And we know that there are factors available in the share market. There's information in the data that's been there for a very, very long time, that if we exploit it efficiently, we can get a very good result for our clients. Now, I wrote a piece last week, you know, wouldn't it be nice if everyone could afford just to put their money in the bank and live off the interest in the bank? Well, that's just not realistic, and even less so today than it ever has been. Most people need some exposure to the share market. If you have to have that exposure to the share market, how do you achieve that in a systematic way where you are more likely to maintain your capital over in the long term, i.e. not make really dumb mistakes, and how then can you exploit the information that's known to get a better result. So that's where our systematic approach has been very, very consistent over the last 15 years, where we have a broad market exposure to large cap stocks, an exposure to value stocks, an exposure to smaller company stocks, and an exposure to or tilt towards more profitable stocks. Now, when you bring all of those things together, it works exceptionally well. Now, there will be, because we're doing something different, and this is really important for our audience to understand, because we're doing something different, we will never perform in line with the market. You know, there've been, over the last 15 years, there's been periods where we've performed significantly better than the market. There's been periods where we've performed under the market. And in some cases with sub-asset classes, take value or small, there may be at a particular period of time a significant underperformance. That's because we're doing something different. The evidence in the long term is that by combining an exposure to large and an exposure to value, small, and profitability, you have a higher probability of a good investment outcome. Now, what I find fascinating with all of that said is that because we don't anchor to the performance of the portfolio per se, and we anchor our clients to, is their plan on track? Whether we are slightly outperforming or whether we are slightly underperforming is largely irrelevant to the client's outcomes. And I think it's a great testament, not just to us, but real financial planning in a broader context, that if people are genuinely reviewing their financial plan annually at least, and resetting expectations annually at least, then a systematic approach to investing money is, I suspect, the most reliable approach you can have. Now, that said, our investment committee is always on the lookout for better ways to do things. And, you know, short of giving the money to someone, you know, with nice shiny red braces and a, you know, shiny red Ferrari out the back saying, I can make more money than you can. Well, what do you rely on? Well, you rely on evidence, systematic evidence that's shown over the 40, 50, 60, 70 years to provide a reliable outcome for investors. And I think that's a really important, it's a bit like my point about rational optimism. We completely accept that there are periods where we're going to be different to the market, but during all periods, it will work for clients because we've got the right anchor points. I hope that helps. I hope that answers the question.
Yeah, that's great. Thanks, Dave. So Graham, I'm just going to move back to you. I'm really interested in what, I mean, I know a guy who's working by choice rather than necessity. So I'm just really interested in what attracted you to working to Capital Partners. And also it'd be good for you to share with this community, as the independent person who sits on our investment committee, what is the thinking and what are the actions that you kind of bring to the table?
Okay, so yeah, so I suppose I do share the state of a lot of your clients since I'm sort of retired. I had the real job and you know, then sort of was working on what do you do next. And one of the main reasons I'm working with Capital Partners is Dave rang me up, which was pretty helpful. And, you know, we've known each other for a long time, and that's great. You know, there's hopefully things that I've learned over the years that can help your clients. And I think the process has, you know, the last couple of years, you know, it's been working very well. And so sorry, I forgot the question. Was something that the next question was how is that process working? Is that
well? So as the independent person sitting on our investment committee, what is it that you're doing? What is the value you bring being that independent person? Yeah,
I think I see my role very much. So a really important part of my role is framing all of the questions. Right. So as Dave mentioned, the committee's job is to always be questioning: is what we're doing the best we can be doing for our clients? And I like to think I can help then come to go, well, then to get some structure to the framing of those questions. And so as we work through various things, perhaps experience also, I can do some translation sometimes of going, we're seeing this in the market, what's going on. But it's a variety of roles, but I think in a lot of times it's asking the question. It's saying, what you really was saying is this, so what we really need to decide, pulling back and say, what we really need to decide is this, to try to bring out the essence of the question. As I spent a career doing that, and hopefully that provides some discipline and some value to clients.
Yep. Thanks, Graham. So Mike, just from your perspective, there's, I sitting on the investment committee as well, kind of, I know that there's been conversations with firms over East as well, as in like-minded firms who are, we're having some different conversations with them. Can you just give some insight into how important it is to, work with other firms as part of our investment committee to build that muscle and to hear different ideas?
It's more about having fresh sets of eyes and ears. It's about having independent, objective thought contributors. And the final bit is just tapping into different experiences and in some cases experiences that extend beyond our 35 years in financial services. What has worked really well, Steve, in terms of the collaboration with these other firms, predominantly within Australia and to an extent in New Zealand and a few in the Northern Hemisphere, it's really about making sure that we are all remaining as focused and as objective as we can be on how best to build portfolios, whether it's looking at asset allocation, rebalancing, investment managers, reducing costs, keep ensuring that the investments that we're using have a high degree of liquidity, they have integrity and robustness in these tough times. So we, as you well know, we make sure that we don't drink too much of our own red cordial, and we really want to make sure that we have, I suppose, objectivity, and that's largely what Graham brings. Making sure that we remain focused, on track, high levels of governance, high levels of discipline. To Dave's point, that our processes are systematic. So with all of the collaboration with the other firms, it's been really valuable to make sure that we tap into different experiences, different client experiences, tap into sort of generations of knowledge. It provides me in particular with a high level of confidence, I suppose, and of knowledge that we pretty well are doing as best we can. There's the old proverbial no stone unturned in the work that we do in researching and looking for ways of managing money.
Great, thanks, Mark. So we've got through all of the questions from the audience that we were aiming to get through today. So Dave, I might just go back to you finally. Have you got any final comments or thoughts that you'd like to share?
Sure, Steve. I think we are at a point in the evolution of this crisis where, because of where markets are at, there's a reasonable sense of optimism. As you quite rightly highlighted, there is a disconnect between that optimism and what we see on the streets of the United States of America. And I'm just going to caution our audience to be aware that there's a lot more uncertainty to come. If we think we're nearing the end of this book, I suspect we might be a little disappointed. I suspect we might be just reading chapter 3 of a 20-page book. There's a lot still to come. I think Graham made a very good point about markets being forward-looking, and I think what we're seeing in the market right now is a genuine sense of all of the market participants thinking, gee, this might not end up being as bad as we originally thought it would be, but that can change on a dime. That sentiment can change on a dime. We've got a very, very interesting year ahead of us in the run-up to the US presidential election. Leadership, and this is probably a little plug for tomorrow, you know, the webinar series that we're doing on leadership on the front foot. What we're trying to do there is to highlight, you know, some of Western Australia's best and brightest leaders, because leadership in a crisis matters so much. I suspect we're going to see a lot of criticism of some of the actions of our politicians and community leaders during this crisis, which, you know, with the benefit of hindsight, I think it's very easy being a journalist, you know, throwing stones at someone who had to make a decision in the heat of the crisis. I think the record stands that whilst our politicians are far from perfect, our decision making so far has been pretty solid. You know, and I think the responsibility that the Australian population and our communities around the country have taken to keep Australia safe have been fantastic. You know, we're also very lucky that we are not global transport hubs. You know, it is a very, Sydney maybe, but Perth certainly is not, you know, Denver or, you know, in New York or Dallas. So we're really, really lucky to be as isolated as we are. My final comment is just to come back to this point about rational optimism. You know, I think we can afford to have a sense of optimism through this. We're going to get through it. There's plenty of historical evidence that suggests we are. Arguably, we're better placed than we have ever been in history because of the strength of our and the advancement of our medical science. And yet all of these things are going to take time. It's going to be a real roller coaster. What I'd like to see our clients doing is to very much be leaning on us during this period. So if people are concerned about something, don't feel as though your questions might be a silly question. You know, rarely are they. Don't feel as though you are wasting our time by getting on the phone and just saying, look, I'm feeling really anxious about the way the world is at the moment. That's what we are here for. And it is during the times of crisis where we can, I think, deliver the most value. The basis for being rationally optimistic, I think, is very, very firmly rooted in the fact that every one of our clients does have a genuine financial plan that has been built on robust principles and has been stress tested during the good times. So you can have a reasonably high degree of confidence. It's not perfect, but you can have a reasonably high degree of confidence that you will see your way through this. And that the actions that you can take in the short term are questions around, well, how much money am I spending? You know, can I spend less to see me through this? And this crisis has actually played nicely into that, because we're not traveling to Europe and we're not doing a whole lot of spending that we ordinarily would. So you have a plan. It's okay to feel awful when things get scary again. We get it. But it's also reasonable for you to be rationally optimistic. Back to you.
Thanks, Dave. Some really good advice there. So that's the webinar for today. So I just want to give a big thank you to Graham, Michael and Dave. Really, really interesting insights today. And I also want to thank the audience. So thank you very much for joining us. So as always, if you're a client, feel free to reach out to your advisor if you've got any questions that have popped up as a result of these conversations. And if you're new to Capital Partners and you're listening to this webinar or you're listening to a recording of it, feel free to have a look at our website or chat or contact Dave, Michael, or myself. Always happy to help. So this video is going to be on our website and also on our YouTube channel in the next day or two. And feel free to listen to it again or share it with family and friends. Enjoy the rest of the week, and everyone stay safe. Thanks a lot.